Welcome to the Daily Update. This is Being Prepared Wednesday, April 6th, where we'll look at the action in the market today and then see how things look for Thursday, April 7th. Quite a negative day. After Monday's session, we were still not looking all that positive. Things were starting to weaken. We needed some follow through buying on Tuesday. That didn't happen. And now we're kind of shifting over more to a negative environment. And Wednesday just proved that out, where bad news is being taken as bad news and good news is even being taken as bad news. So things are a lot more skeptical now. We're seeing more of a negative tone to the market. Now we have to ask, is that going to continue? Are we going to find support somewhere? Are we going to find something that the market can use as a catalyst to go higher? That's kind of the question where we're at right now. So let's go back and talk about what happened on Wednesday. The futures were quite negative, and during the night, interest rates were really going up. That was pushing the S&P futures down as well, and Europe had a pretty rough day. Just everything is switched more to a real negative environment right now as far as sentiment, at least with what people are feeling. We're not really seeing that in some of the measures that we use, which could be a sign of concern. People aren't afraid enough yet for things to hit more of a critical mass. We're pretty much right in about the middle. So that you could take that as either way, that people haven't turned really negative, but we want to also see that people see the fearful situation going on and start to react to it. And that usually leads to a change when it gets to an extreme point. But we gapped lower. We even gapped below S1 at the open. And then we saw an increase in selling down to S2. Now, what's kind of interesting is we've seen a real shift over the last, 10 to 15 years, where when the Fed meets, that used to not be a big deal. And then it turned into a big deal where they would come out and make their announcement. Then it grew to the point where they not only make their announcement, they do a press conference. Well, then about 3 weeks after the meeting, the Fed minutes are released. Used to be pretty much ignored. Didn't pay attention to that very much at all. Now that's becoming a big deal too. And what we typically see on Fed days is we'll have a little gyration at the open, which is what we usually see. And then the market settle down and kind of chop sideways, usually with a little bit of an upward bias. And then the announcement comes out and the market gyrates all over the place in response to that. Well, what we saw on Wednesday with the Fed meeting minutes coming out, or FOMC meeting minutes, was prices really dropped a lot lower. And then they chopped around for a little bit and then reacted to the meeting minutes coming out. And there wasn't really any surprise. We knew what they were going to say. But again, as I've stated over and over, that it's kind of like somebody that's going to be passing away. They've been sick for a long time. You see their health declining and you know that they're going to pass away. And so you're kind of prepared for that. But then when it finally happens, now you have the shock of that event actually occurring. And in some kind of a way, because we think along these lines, it's kind of that way with the FOMC. We know what's going on. We know what's happening if you pay attention to things. And then when the Fed actually does something, you still see a reaction to that. Well, that's kind of what we saw on Wednesday. And now the minutes, especially when we're in this kind of an environment, have become just as important as the meeting itself. So after the release, or let me back up a little bit. We saw, after things settled down after the open, we saw some sideways action. There were some failed buying attempts. We tried to go a little bit higher there for a bit. Again, was that buying or was that closing out short positions? Those attempts failed until the FOMC minutes were actually released. They came out at about 2 p.m. Eastern time, and people just start diving into this already. And they look for keywords and the market can react one way in the first few minutes, and then it can turn around and react in a different way later on. And that's kind of what we saw. Then after the release, there was what I'm calling just a relief bounce. Just, okay, now the news is out there, and we were able to get back to S1. And then we saw a bit of choppy price movement, but then we were still negative anyway. We really didn't recover much of anything. We did close a bit off of the low, but it was still down 0.97%. We were down well over 1% there for a while. So we saw a little bit of buying coming in, and we ended up closing down not quite as much. The interesting thing is, volume for the first time in quite a while was actually above average on Wednesday. The technicals that we're looking at, they're turning more and more negative. Some are still positive, but they're showing weakness. Some of other indicators, and I'll go through the charts here, are actually already negative. And that has to do with inflation and interest rates. That's really the main topic as far as the stock market is concerned. Of course, there are other geopolitical events, Russia, Ukraine, some of the news coming out of that, not really getting any kind of an agreement. There's been talks of increased sanctions against Russia. And even our own officials are telling us, yeah, we might be putting sanctions on Russia, but that's also going to affect us. That's going to affect our gas prices. That'll affect our food availability. And that's really going to have some damaging effect on our economy as well. So it's not just sticking it to Russia, we're kind of also sticking it to ourselves at the same time. And that's not any kind of a weird theory. We're hearing that from our own government. We still have inverted yield curves. I think the 2 to 10 actually switched back positive on Wednesday, but we still have other yield curves that are still inverted. We have others that have not gone inverted. And then oil, which kind of feeds into the whole gas thing, that's still going around as well, as far as a real concern to be fixated on these days. So what are some comments? The technicals are weakening and turning negative. Interest rates rising. This seems to be what is causing, at least in the short term. We're seeing a real rise in interest rates that are going up pretty drastically. And then the Fed speak that we saw after Tuesday, well, with the meeting minutes, and they kind of put it all together, and that still had some carryover effect into Wednesday's session. And then some other statements and things that have been made that added to the overall negative environment. We're still in kind of a short-term range. Now, we might be getting ready to break out of that. Probably, it looks like it might be to the downside. But are we going to be able to find some support somewhere? And then the small and mid caps, they didn't really participate in the up move, but they're still participating in the down moves. And that's a little bit of a concern. In a good, healthy environment, you not only want to see the big stocks do well, you want to see the small and mid caps performing well also. And that's just not happening right now. It's like, yeah, we'll go with you if you're negative, but if you're positive, we're not going to join the party. The S&P, this is also negative. We dropped back below the 200-day simple moving average. Okay, so now our longer term trend is switching back to more of a mixed environment. The 20 period simple moving average, it acted as support because it moves a little bit slower. So the S&P was able to bounce up off of that. And then we ended up closing at the 20 period exponential moving average. So you can see how these moving averages can come into play. Sometimes we just blow right through them. Other times they actually provide support or resistance. And we're not seeing a lot of fear in the gauges that I look at really coming into the market. Sentiment is not really dropping right now. Of course, the big event that I mentioned are the FOMC meeting minutes. And it showed in those minutes that, yeah, there are inflation concerns. Okay, we already knew that. There's also a need for tighter monetary policy, which means quantitative tapering. What we're seeing right now is called quantitative easing, where the Fed is in buying bonds not only treasuries, but corporate bonds. Well, when they start to stop that, I know that doesn't make a lot of sense, but and then they start to get rid of these things that they've been buying, that is quantitative tapering. And they're thinking as early as May, they may start being able to do that. Well, some people say, no, they should have been doing that already. Look at what's happening. We've got interest rates going up and you're still buying bonds right now. Your balance sheet is still increasing. And as I've said before, it's like having your foot on the gas and on the brakes at the same time. Well, one of them is going to have to give. And what's that going to do to the economy? What's that going to do to the stock market? Because for the last couple of years, especially since the COVID plunge, you can attribute a lot of the gains in the market to this quantitative easing. It goes into the bond market, that pushes bond prices down, and interest rates, that pushes bond prices up when they buy, that pushes interest rates down. Well, people aren't really seeing much of a return in the bond market with interest rates so low. So then they come over to the stock market and they buy. And that really helped fuel a lot of the advances that we saw in 2020, 2021. Well, then it started to come to a head in late 2021 and has really affected the S&P price since the beginning of 2022. Now, as far as the market valuation, that really won't change for another week. It's still fairly valued, mainly because that model uses the 10 to the 3-month yield curve, and that yield curve is still quite positive right now. It is not close to going inverted at the current time. As far as our trend, we saw a crossover. The red line went below the green line, and I'll show you that. And we're more negative now, but we're still weakening because those two lines are pretty close to each other. The bias is negative, and now the momentum continues to be negative. So as of Wednesday's close, we're looking a lot more negative than we were just a few days ago. So let's go back through, look at the day's session. First of all, look at sentiment. This is a bit of a concern. We were at 51, just a little bit to the right of being neutral. Now we switched a little bit to the left of being neutral. We're not seeing a real pickup in fear, at least yet. Could that mean that we have more room to fall from here until sentiment gets much more fearful? That's one possible scenario that we need to keep in the back of our mind. People are not really freaking out. They're freaking out in other areas, but they're not really freaking out as far as this index is concerned. And then this longer term chart just shows you we're just in about the middle of things. The VIX, it did pick up and it's back above 20. It crossed above 20 yesterday, but it just continued to climb. And as prices gapped lower, you don't see a lot of gaps in the S&P 500. You do sometimes. There's one back here in last September and everything, because you see it calculated more, I don't know, it flows a little easier. You might see more gaps on the ETFs, and you definitely see gaps in stocks, but we don't see as many gaps with the S&P because it kind of rolls into the new numbers as things start to open up each day. But we did gap lower right up here, and we didn't close at the low. There was a little bit of a bounce at the end, but overall the VIX is starting to increase, so fear is picking up both on the line chart as well as the bar chart. But we're still up to we're coming up to the moving average that I have plotted. Now, if you use 20 as a static number, which for decades that's what I would use, and I still use that, but I also plot some moving averages here because that measures more of what the VIX itself is doing. So when we're above 20, and if we break through these moving averages, that's kind of, for me, that's more of a double confirmation that fear is really rising. Then the VIX, it saw a real spike up on the bar chart, but actually declined a little bit with the line chart. So it wore off a lot of this fear as we got closer to the close. That could be somewhat positive. And I call this the UA, and I apologize because I was an instructor for a lengthy period of time in an environment where we had to do UA tests on our students, and so I got just used to saying it that way. It should be UI, and some of you may not even know what UA means, but I slip with that sometimes. But this is the ulcer index. As fear comes back into the market, this index will climb. Well, it is climbing, but we're still below the moving average right now. Looking at the sectors, the ones that got hit the hardest: discretionary, tech, communications. Okay, those are the kind of the big three that they're the last place sectors. When we go over to the next chart, they've been kind of jostling around. Well, especially discretionary and communication, they kind of go back and forth from time to time, but these are our three weaker areas. A lot of the middle areas are more the value plays of things. And then we did see energy up, even though oil fell, the sector still ended up advancing. Let's see, staples, that's a value play that saw an advance. Real estate, a lot of the real more defensive things, healthcare, utilities, which have been doing pretty good all along. Pretty much since the beginning of the year. It's a well-performing sector. Not as good as energy, but it still has been holding up. In fact, here it's in second place. It's kind of this maroon color where we're up 9.5% from the all-time high, where energy is still way in the lead, even though oil fell. And then in last place comes the discretionary, then we have communications, and then tech, which are well into double-digit losses since the all-time high. Then here's the tech sector chart by itself, where we've now fallen below the moving average. And we were down 2.37% on Wednesday. So that's decidedly more negative. We had been trying to stay above this moving average. Well, right now we've not been able to do that. As far as inflation, the CRB was actually down a little bit, but still this overall just screaming uptrend continues to be intact. Here is the CRB against the S&P 500, which just shows that commodities are outpacing stocks, or the S&P 500 stocks currently. And then here's an inverse of that same chart, where the S&P has really been underperforming, especially since the beginning of the year. Mostly negative technical alerts. NASDAQ below 14.5, 14.4, 14.3, 14.2, 14.1. Sounds like a blast off. 1400, 13.9, 13.8. So the NASDAQ did not have a good day. One of the positive things is staples, the things that you have to have, a real defensive play. It's now crossed above 70 with its BPI. So that's showing continued strength. And then the dollar, which really, people just say death of the dollar. We're going to have digital currency. Dollar is fiat currency. It's not really backed by anything. Well, I look at it just a little bit different. And yeah, it's not a very good currency, but it's the best of all the other crappy currencies that are out there. You might argue against that by saying the euro, because its value is greater, but no world currencies, at least the major ones, are backed by anything right now. And so at some point we're going to see some problems with the dollar, but not today, not right now. In a rising interest rate environment, that makes the dollar more precious because it costs you more to borrow it. And so that has a tendency to really help the value of the dollar itself. Intraday, we gapped lower, we gapped below S1, and then just kind of kept going right after that. And the futures were pretty much telling us that. They turned pretty negative during the night and kept that negativity going right into the open. Then that took us down to S2. Then the open kind of got finished doing its thing, and we kind of traipsed along sideways. We tried to go up a little bit, but only to come right back down. And this is like the pre-Fed movement that is very common to see. And then we saw a little bit of a run up going in here, and then a little bit of a drop. And then boom, you see this big candle here. That's when the Fed meeting minutes came out. We were able to try to shoot back up to S1. That didn't last very long. And we ended up going back down. We dropped below S2. Well, we fell pretty far, pretty fast. We saw a bit of a bounce coming up out of that, back up to S1 again, only to fall back. And so it was very choppy going into the close. And it was we didn't even come close to filling this gap at all. So here's what it looks like on the daily chart. We see the gap again. And now we're not really dealing with these overhead resistance areas, at least currently. We're starting to fall back after hitting these resistance areas. Can we stay above the pivot? That's going to be kind of the next line here. And that's at 44, 41, 86, I believe that is. If we fall below that, that's going to turn things much more negative. Looking at the bottom, you can see we saw a spike above the moving average here, so that volume really did pick up. It's one of the few days we've seen in the last few weeks where volume was above average. We're now down 6.58% from the all-time high. Growth just got hammered. Value saw some real strength. And you can kind of combine that. A lot of the action that we saw on Wednesday was just kind of a continuation of what we saw on Tuesday. That had nothing to do with Monday, with all the love everyone is feeling for tech and for Twitter. Here's the growth index against the value index. So growth is actually dropping below the 50-period moving average, where here the value is climbing above its 50-period moving average. Then the NASDAQ 100 really underperformed again against the S&P 500. Here's the pure value index. It was actually up, not very much, but it had a positive day where growth just got slaughtered. We actually went down back below the 50-period moving average. Then comparing a couple of ETFs, the growth ETF against the value ETF, we saw almost a 2.25% decline in that ratio. As far as our trend, this is what I'm talking about with the ADX continuing to decline. It's currently at 20.49. If we drop below that, that's a static definition of a non-trending environment. Another definition is when this thick line is moving down quicker than the moving average line. So that would be more of a confirmation that we're could be getting into a trendless environment. And this is also showing a change. The red line is just barely crossed above the green line. So now we've switched back more to a negative trend as far as the ADX is concerned. The Arun's not really moving all that much because it still picks up these recent areas that we were in as we were going up a few weeks ago. So in its calculation, it doesn't really count those. And so it's not moving all that much. But because we're having a down day, we're seeing a bit of a decrease in buying power, but we're also seeing a bit of a decrease in selling pressure. And overall, we're just kind of going sideways, although we are still above zero. No change in the decision point market scoreboard. And okay. All right. Then as far as looking at breadth, we saw a real decline based on price, and we are seeing a continued decline based on volume. So that's looking more negative. The ADX is still above zero. That's positive, but declining at the same time. New highs, new lows. We're now trending down based on this moving average, and we're kind of a little bit flat right now with our 10-day moving average. But if we see some more follow through weakness, this is going to start to turn down as well. Accumulation distribution, it seems to be hanging in there a bit. It was pretty much flat, and we're still above the moving average. Short term, we're back down to the 20-period moving average. We actually used the simple moving average as support. That's the red one. And then we closed right at the exponential moving average. So that's always kind of interesting when that happens. Our moving average study, a decline in the 20, decline in the 50, decline in the 200 day. to a little bit sideways there. Here's our spaghetti. We after enjoying some time above the whole mess, well, now we're coming back into that. We dropped below the 100-day moving average. We came right down here to which one? That's the 20 that I had plotted that I already talked about. That was a level of support. And then we went right back up to the 20 EMA to close. MACD still positive, but really beginning to roll over. Another session without some real strength, and this is probably going to roll over. STO declining based on price, declining based on volume. McClellan oscillator just barely went down to a negative reading now. Stoke RSI pegged negative. Williams percent R crossed back below 50 and declining, but it's not extreme at this point. The force index has also switched over negative with this red line or arrow that you're seeing there. Intermediate term, where we were able to close above the 50-period moving average, but we actually dipped below that for a while. And then here's the 100-day. We just were not able to hold on to that. We dropped below the exponential 100 and we're able to close just slightly above that. PMO rolling over based on price, rolling over based on volume, rolling over, but still considered positive. Our PMO study, those that are rising, is really starting to decline. The ones giving buy signals after giving us an extreme positive reading, it's dropping back down. And those that are above zero, it's flat to slightly down. BPI, and I've tried to change how these bars are displayed. I made it a little darker with this, where after having an extreme positive reading is now, it has generated that overbought signal, but is still continuing to decline. And then here's the longer version of that same chart. Rainbow, we're kind of dancing around with all the different colors right now. Stochastics, and they were negative across the board after yesterday's session. Well, with the decline today, we saw a further decline in the stochastics, short-term, intermediate, and long-term. And this is still in this kind of extreme positive area and will generate an overbought signal once we cross below this line. So if you're a fan of stochastics, this doesn't look very good to you. The Sean trend meter, after trying to blip up a little bit, is now back into this kind of constipated yellow area and is still declining. And then the 20-period rate of change, after giving that extreme reading, is wearing that off. Then here's the summation index, turned sideways to slightly down because the McClellan oscillator was negative. But we started to see this a few days before with the summation index based on volume rolling over early. And sometimes that, I tried to point that out in the videos, and sometimes we can see that coming. That's one of the things I like about this bottom indicator, is it can be a leading indicator sometimes. Our different momentum oscillators are starting to be more mixed. We've gone negative with the slope. We're rolling over with some of these other ones, and some of them are still going up, but starting to roll over a bit. The vortex, which looked a lot stronger after yesterday's session, well, it really just tanked. It hasn't crossed negative yet, but it's weakening in the buying power and strengthening in the selling pressure. RSI is still above 50, but declining. And then here's our itchy and scratchy cloud, where we're starting to come right back. And I don't mean to be disrespectful. I just can't say that long word, Ichimoku cloud here. Plus, I'm a big Simpsons fan, where I actually wasn't showing this chart for a few days because we were well above this cloud. Well, now we're starting to come back into the cloud. Trading systems, we are negative with the elder system based on the S&P index, and we're negative with the spiders. And then this is another change. Our SAR has picked up this move down, and now there's a dot above price. So it's switched from being positive to negative now. Then our different charts, Heiken Ashi showing weakness. Kegi redrew, turned red, and that is now negative or showing weakness. Renko hasn't picked that up yet because it's still seeing the prices, these same prices that we were at not too long ago. In our 3-line break, it redrew and is added a solid candle now. Equivolume, again, just showing a red candle. No change on our point and figure chart, because we're back to where we've been before. And until we really drop below some of these prices, we get below 43, 4250, 4200, we probably won't see any signals generated on this chart. Long term, we've dropped below the 200-day. The 200-day moving average is at 4490, and we closed at 4489. So we're about 9 points below the moving average right now, and the same thing with our logarithmic chart. The mega stocks, which just had all the love on Monday, well, they've been just taken out and shot over the last couple of days, down another 2.5% in Wednesday's session. The special K, and this is pretty slow. It's going to take a while for this thing to roll over, but if we see a lot of follow through downside price movement, this could move down. Our moving averages starting to show some more weakness. 50 period declining, 150 period declining, 200-day declining. Looking at some other indexes, the S&P dropped lower, and here's the mid caps. Didn't really participate in Monday's update, but boy, have they sure participated in Tuesday and Wednesday's down days. And you can say the same thing about the small caps. And then the Dow Jones Composite. Again, the trannies have just been getting hammered. They're just not doing well. Supply chain issues, gas prices, diesel, all that stuff is just really feeding over into the transport sector. But utilities have been doing well, but not the trannies. And we're dropping down and possibly even starting to fall below the 50 period moving average here. The FANG stocks just got hit almost 3.5% down to the 50 period moving average. We closed a little bit off the low, but still, this was a pretty damaging day. ARC also had a bad day, down 4.63% after looking like it was really breaking out and getting above this 50 period moving average. Well, we've dropped below that now. The Dow fell below its 200-day moving average a few days ago. It's flirting a little bit with the 50 period moving average, and it really wasn't down all that much. It was down 0.42%. So it held up a little bit better than the S&P on Wednesday. Our diamonds but have switched over to negative with the red bar based on the Elder Impulse system. Small caps down over 1% and not looking really healthy, but we're kind of going back into this whole sideways pattern that we've been in, seems like endlessly. Mid caps also fell below the 50 period moving average and back into more of this mess where we've been before. NASDAQ, it down 2.22%. And one positive thing you could see right here is we have the moving average and the pivot point just about at the same level, and we were able to bounce up off of that. Can we stay above the pivot? That's kind of the next question. NASDAQ 100 also came down almost to the pivot. The moving average isn't quite as close, but can we stay above the pivot? And if we fall below that, can we stay above the 50 period moving average? The Vixen, with the decrease in the NASDAQ 100, we saw an increase in the Vixen, but it closed in about the midpoint because we did see some late day recovery. The Qs dropped below this moving average and are declining down over 2% on Wednesday. NYSE, this has been kind of our hope that we could stay above the 200-day moving average. Well, we lost that on Tuesday, and that was a little bit more confirmed. Even though we came down to the 50 period, that acted as support, and we're down close to this pivot level, we were pretty well off the high, off the lows on Wednesday. That could be a bit positive, but we're not seeing it from the growth stocks. We're seeing any kind of a bounce really coming out of the value stocks right now. S&P 100 underperforming the S&P 500. Wilshire getting down to this 50-period moving average after losing the 200-day moving average, and it was down a little bit wider. It was down 1.18%, or a little bit stronger, I should say, not wider. China, which is just coming off of being in a holiday, and this is the KST. This is a much slower oscillator that I use, and that's one of the reasons why I do this, because it doesn't change all that often. See how the S&P is still going up in this indicator? We'll see that until something really significant starts to happen. And you could also take this as positive, because maybe we're just falling back before we're getting set to go higher. There's still a positive backdrop out there. It's not really in focus right now, but it's still in the background. All right, and then our all stocks, after coming off of the 200-day moving average, are now heading back down to the 50 and declined over 1%. Here's our non-US index. It was down 1/3%. Overall, broad market, the dollar, that's been holding up right now. We're getting over 99. It's going to be interesting to see if we can get above 100 with this. Here's the weekly chart thus far with a solid uptrend. Oil dropped down below 100 and is currently at 96.23. Gold also down 1/4% and kind of being a real, again, if you're a trend trader, you're disappointed in this because it kept looking like it's going to break out only to fall back and then just kind of bob all over the place. Here's the longer term look at the gold ETF. Silver was actually up almost 1% and was able to get back above the 50-period moving average, but still we're just in a conglomeration of messy price action. And then here's the longer term look at that silver ETF. Bitcoin's been having a little trouble, and it was up in the upper 40s there for a while. Now it's back down into more the mid 40s, but that's not a big move for Bitcoin. So if it's bouncing between 50 and 40, well, we've been kind of seeing that now for a while. What people want that invest in that, they want the huge breakout to the upside or the huge collapse to the downside. They don't really like the sideways action stuff. They want movement. They want action, baby. Okay, bonds. We've actually gone back positive with the 10-2 yield curve. We're still inverted looking at the 10-5 yield curve. We're also inverted looking at the 30-5 yield curve. But we're still going up when looking at the 10-3 month yield curve. And then here's the 10 to the Fed funds rate. It is still positive. So when we look at all these together, you can see we have two yield curves that are actually advancing and other ones that, well, two that are inverted and one that was inverted and is now switched back above and is no longer inverted. And again, you might want to pause this, maybe try to make this chart a little bit bigger. But look at what has happened in the past with the S&P after we've seen inversions. But we're not seeing an across the board inversion. That's one of the concerns. Here's our yields just getting to be all messy and really consolidating with each other overall. And then here's the international rates thus far this week. And then bonds, with interest rates going up, bonds are starting to break down based on price. So this red line here, we're starting to drop below that. Corporate bonds also saw some weakness and a bit of an advance to 3.44% on the yield. Junk bonds, the market was down, so junk bonds were down 0.81%. Relative studies, here's the gold S&P 500 ratio, which is, it was actually up a bit because the S&P fell more than gold did on Wednesday. Here's energy against the S&P. The energy sector did pretty well. So this is still looking like a solid breakout in an uptrend. Growth versus bonds, growth really underperformed, but bond prices are underperforming too. So this was down 1.61%, but they're both having their own individual problems. Tech against the S&P after coming up to the 200-day moving average is now bouncing down and down 1.38% in the ratio. Here's tech against the 10-year. Yeah, with interest rates going up, tech has really been going down. Here's the inverse chart. Interest rates are going up and really outperforming tech right now. Discretionary against staples. Discretionary really got hit. Staples were much stronger. This ratio was down 3.77% on Wednesday. And then the S&P against the 2-year yield, where it just shows the S&P is really underperforming the rise in interest rates. And then here's our low volatile stocks. It's kind of interesting. This, if you just got into this ETF, you were up 1.45%. Then here's the ratio of the low volatility stocks against the S&P itself, where the low volatility stocks are showing a breakout. It was up 2.48% in this ratio. Is that going to last? That's the thing. So what is our outlook then for Thursday? The technicals, we have some of them are negative in the charts that I've shown you, and others are weakening. They haven't officially switched negative yet, but they're not looking really strong right now. The market still remains in this intermediate term range, and that's pretty much where we've been for all of 2022. There's still the battle daily. Monday, growth won. Tuesday and Wednesday, value won. So then the yield curve concerns, we just want to watch those every day. We're dealing with a lot of the different oil issues and supply chain issues. Then the economic reports that are coming out on Thursday, we have the weekly jobless claims that'll be coming out, and then consumer credit will be coming out as well. And then all the geopolitical things that I keep talking about, and I just don't want to keep repeating because I'm saying the same thing all the time. So what are our scenarios? What's going to make the market go down from here? I've taken off that short-term overbought, wearing off scenario because we're way beyond that now. We're seeing rising interest rates. That was the cause on Wednesday. Not, well, yield curve concerns, but that's more longer term economic concerns. But the rising interest rates, and that's what really helped the futures go negative during the night and then kept them negative during the day. And then scenario B, for things to keep going down, the internals are weakening, and the broader markets, we're seeing not as much as in the Dow. It's holding up a little bit better, but we're seeing the S&P 100, the NASDAQ 100, mid caps, small caps. We're seeing pretty much across the board weakening. What can we do to go up from here? Well, first of all, our oscillators, some are still positive, but others are turning negative and are weakening. The moving averages, as I pointed out, might provide some support. If we do get any kind of a bounce, they might provide resistance. And then this is what might lead into something, not necessarily for Thursday, but if we keep falling the way we've fallen over the last 2 days, that's a pretty fast drop. Are we going to see some kind of a bounce come out of that? Just people getting out of short positions. And of course, they have to buy to get out of those. So we'll have to see if we do that. And will a support level be found? Will that support level be in the S&P? Will it be some kind of resistance with interest rates? Will it be in one of the other indexes? We don't really know right now. Are we going to find support somewhere? And then sideways. This is looking, again, a little more likely, where we had been in an intermediate term range, but having wild swings. So the ADX was staying pretty strong, but now the ADX is weakening and has actually turned negative. And if we see that drop below 20, we might see a slowdown in price movement and getting into a trendless, choppy, sideways type of market. So what's our conclusion? I've changed this around a little bit. The S&P is still positive, kind of, and not real positive right now, but it's showing weakness and is turning negative. It's because we have a real mix right now. Short term is also mixed and weakening. Intermediate term, positive, but weakening. Some of our oscillators are positive, but others are weakening, and a few of them have even turned negative. And then we're looking at our different moving averages as either right now, mainly for support, but if we have some kind of a bounce, it might be resistance. Our long-term trend is now back to mixed because we are below the 200-day moving average. And again, just if you want to pause this, these are the different videos that I try to do. The daily ones are first this full length daily video, and then I go back and I do a snapshot video. And then every weekend I put out a weekly video. And then at the end of every month, I put out a monthly video. These asterisks are just videos I intend to do, but have not posted yet. So thank you. Have a very good Thursday. And if you're a baseball fan, you're probably looking forward to opening day. I'm a baseball fan, so I'll be looking forward to that. And I'll prepare the next video after Thursday's session.